Peter Cardillo is Chief Market Economist at Spartan Capital Securities. He's joining us now to sort of tell us what he's making of things. Peter, good to have you with us here. Thank you very much. 2 points. One, do you think that the Fed was sort of pretty dovish out there? They're basically saying that inflation could be higher than what markets expect, but the process of disinflation is on and rate cuts are coming. I mean, I think that was the key message. That is one. Would you agree with that? And are there any nuances to watch out for? And second, yields did not move. I mean, the 10-year was down just one basis point. I mean, it's absolutely flat. The dollar did weaken last night, and equities went up, but nothing very large. Your thoughts, Peter?
Yeah, well, there's no question that the Fed statement was basically unchanged from the previous one, and they stick to their script. There's no question about that. But the good news is that the dot plots is still signaling 3 rate cuts, and basically the message is that while inflation remains elevated, the Fed continues to believe that inflation will come down. And so I think that's the reason why we saw the markets respond in a very positive way. I would also add to that, add to the fact that the majority of Fed members are still looking for 3 rate cuts, and there was maybe 1 or 2 that penciled in 2 rate cuts. So the essence of the communique was we are going to cut rates this year, and up until today, the bond market was quite leery of that. In fact, we had a huge rally in yields over the past several weeks, and that was due to the fact that the market was expecting a scale back on future rate cuts. So all of that today, you might say, vanished in a sense that the market made an about face. Of course, yields didn't come down that very much because I think the bond market is waiting for confirmation that inflation is headed back down. And I think another key point here was the fact that Chief Powell alluded to the recent rise in inflation, that it was due to seasonal factors. And so the bond market wants to be convinced of that. And I think once the bond market is convinced of that, then I think you'll see yields reverse course. And I wouldn't be a bit surprised to see the 10-year go back down to the 4% range.
Okay. Peter, hi, good morning, and thanks a lot for joining in. So how are you positioned on emerging markets like India? Because the macro environment has improved substantially here, whether it's, growth picking up, inflation has been pretty stable, earnings have come back, and the equity markets have followed suit. But what is your prognosis now for the next 12 months?
Yeah, I think, emerging markets are going to do well, just like the major markets are doing well. In India has been a particular situation in a sense that the economy is likely to become the 3rd world largest economy. And there's a good chance that that India might match the Chinese economy and actually surpass it. So I think the right way to be at this time is to be fully invested. If you're going to invest in emerging markets, obviously India is the first place I would bet.
Okay, all right. Hi, Peter. It appears India's in this structural uptrend and the market looks good, going by, a stable government, the reforms that are ongoing here in India as well. But in the near term, do you see a case that China does a relative outperformance? Because it's been a rank underperformer. Valuations there are reasonably attractive. And now some data points are suggesting that maybe, in fact, they're going to come out of the mess that they have been. Or would you just stick to the structural theme, which is India?
No, I think that, look, there has been some good news out of China recently, but I think they still have a long way to go. You know, they've put a lot of money into the economy. They've kept interest rates in a downward path. And so when that happens, behind the scenes, there are structural problems in India. I'm sorry, in China. But, you know, I don't think that China is ready to reverse the malaise that they have been in. And I think that, you know, as I said before, India is far ahead of growth as opposed to China. So, you know, I think we still have some time for China to get back on its feet. And of course, the biggest problem has been and still is the real estate.
Okay, all right. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV 18. That's the word coming in on the Fed decision and the way forward.